I'm willing to bet that you've heard the term assumable mortgage at least once within the past few years. Higher interest rates are forcing agents to get creative and find solutions to their clients' problems, like rising interest rates, and assumable mortgages have been a topic of discussion lately. This is a great way for buyers to be able to take advantage of a seller's existing interest rate. And I've seen a lot of social media creators highlight the interest rate aspect of this concept. But where they typically fall short is that they leave out a lot of other important and expensive details. I think that if you're educating people on anything, it's important to talk about the topic as a whole, the good, the bad, and the ugly, so that people can take that information and make the best decision for them. So I'm here to educate you and answer your questions, and hopefully I'll do a good enough job that you'll like this video and continue to allow me to educate you on other real estate topics. I'm Staci Russell, your Northwest Houston Realtor, educating buyers, sellers, and investors on all things real estate. Before we jump into assumable loans, let's take a look at the traditional mortgage structure. A traditional mortgage is a loan that's typically secured from a lender. It comes with an interest rate that you'll pay off over the life of the loan, which is typically anywhere from 15 to 30 years. There are a bunch of different loans out there, but a few that you might be familiar with are conventional, FHA, VA, and USDA. Over the past few years, we've seen interest rates dip to record lows and then rapidly increase for the Fed to fight the crazy inflation that's been happening in our country. And while current interest rates are not historically high, they are high to first-time homebuyers who have never seen rates like this before. Tack on increasing home prices, and a lot of these buyers probably feel like they're being priced out of the market. Enter the assumable mortgage that you've been hearing about. So here's the good part. Like we said earlier, an assumable mortgage allows a homebuyer to take over and assume an existing mortgage of a seller. Because of this, a seller can save a buyer from getting a new loan at a higher interest rate. And that sounds pretty good, right? But once again, we have to talk about all of the components of an assumable mortgage, not just the best parts. So here are some important details that you may not have known about. Number one, not all loans are assumable. Changes in lending practices have reduced the amount of assumable mortgages because of the risk that's involved. Assuming a mortgage is a voluntary agreement between a lender, a buyer, and a seller, and it's a very different process than a buyer applying for a traditional mortgage loan. It's important to note that while assumable loans aren't as common as they used to be, government-backed loans like FHA, VA, and USDA loans do allow for a buyer to assume a seller's loan when certain terms are met. It's really important to work hand in hand with the lender and possibly even a real estate attorney to make sure that the transfer is done correctly and both parties are protected. Number two, the lender of the original mortgage must approve the mortgage assumption before the deal can be signed off on by either party. A buyer will need to demonstrate creditworthiness, employment, income, and the ability to repay the existing loan. Number three, the buyer will take on the responsibility for the existing loan terms. When a buyer assumes a loan, they also inherit the existing terms of the mortgage. This means that the buyer will need to comply with the specific clauses, conditions, or restrictions outlined in the original loan. It's important to review these terms and make sure that they line up with your financial goals and your circumstances. Number four, the buyer's down payment could be expensive, and this is a big one. The amount of equity a seller has in their home will impact how much of a down payment a buyer will need to bring. If a seller's equity is low, the buyer will need to bring a smaller down payment. So here's an example. If the value of a home is $250,000 and the assumable mortgage balance is $210,000, then the buyer will need to bring $40,000 as a down payment. On the flip side, if a seller's equity is high, the buyer will need to bring a larger down payment. An example of this is the same terms. If the home is valued at $250,000 and the remaining mortgage balance is $110,000, then the buyer will need to bring $140,000 as a down payment. In either of these situations, a buyer has a few options. They can pay the difference in cash, or they can take out a second loan. But I have to be honest with you, secondary loans typically have a much higher interest rate and they may not work with the terms of the assumable loan. They can also increase the risk of default. Number five, assuming a mortgage is a faster and easier process. The paperwork and underwriting process can be streamlined because the existing loan terms have already been established. Your closing costs may be reduced. When you assume a loan, you may be able to avoid some of the traditional closing costs. Check out my video, Unveiling Buyer Closing Costs, to get an idea of what fees and charges are typical for a buyer to pay at the closing table. While assumable loans can be a great opportunity for buyers, You should use your real estate resources to get information on the existing loan terms, interest rate, and remaining balance. You should also consider factors like the condition of the property, the market value of the home, and any potential risk before making your final decision. Now that you know a little bit more about assumable loans, feel free to drop your questions in the comments. I love getting feedback from you and getting to connect with you on YouTube. If you found this video helpful, don't forget to give it a thumbs up and subscribe to my channel so that you never miss a real estate video from me. As always, thanks for watching, and I'll see you in the next video.